When you think about a bank, what comes to mind? Probably getting a loan for a car or maybe a house, right? But behind every single one of those loans, there's this whole complex web of rules. And these aren't just rules for rules' sake. They're designed to steer a bank's money to where our economy needs it the most. Today, we're going to unpack two of the most important ones, ANBC and CEOBE.
So let's kick things off with a really big question. How do you actually get a massive commercial bank to lend money to a small farmer, or to a student who needs an education loan, or a small business that's just starting out? I mean, you can't just ask them nicely. You need a system. And that system has a name. It's called Priority Sector Lending, or PSL for short. This is basically the government's main tool to make sure a certain chunk of a bank's money goes towards these crucial sectors that, let's be honest, might otherwise get overlooked. We're talking agriculture, education, small-scale industries, the real engines of the economy.
Okay, so it sounds simple enough, right? Just tell a bank, hey, you've got to land 40% to these sectors. But wait a minute, 40% of what exactly? You can't just pick a number out of thin air. You need a consistent, fair, and stable number to apply that percentage to. You need a base for the calculation.
And that's where our first acronym, ANBC, comes into play. It stands for Adjusted Net Bank Credit. The easiest way to think about it is as the Reserve Bank of India's official measuring stick. It's how they get a true sense of a bank's size and its lending operations, so they can set those really important targets.
So, how do we actually build this measuring stick? Well, it's a pretty straightforward two-step deal. First, you start with what's called net bank credit. That's basically the bank's core book of loans. Then, you add in a very, very specific type of investment in bonds.
Net bank credit is pretty much everything you'd think of as a loan. But hang on, look at what's excluded. Bills rediscounted. Why's that? Well, think about it. If a bank sells that loan off to the central bank, they've basically passed the risk on. It's not really their exposure anymore, so it can't be part of the base calculation. Makes sense, right?
Now, what about those bonds that get added? These aren't your typical government securities. We're talking about corporate or infrastructure bonds. And here's the really crucial part. Only the ones that are marked as held to maturity get counted. The logic here is super sharp. This rule treats a long-term bond purchase just like a loan. It's a real long-term commitment, and it stops banks from just buying and selling bonds to wiggle out of their lending duties.
Okay, but here's where things get a bit tricky, where modern banking throws us a curveball. Not all of a bank's financial promises are nice, neat loans that you can see on a balance sheet. What about all the other potential risks a bank takes on, the hidden stuff?
And to tackle that, we need our second hero acronym, COBE. That's a mouthful. It stands for Credit Equivalent of Off-Balance Sheet Exposures. It's a really clever way to take all those hidden risks and convert them into a single number that we can actually compare to the bank's main loan book.
So, what are we talking about here? Well, think about things like bank guarantees or letters of credit. These are absolutely vital for trade. Or what about all those complex derivative contracts? These aren't exactly loans right now, but they represent a promise to pay in the future, and they carry very real risk. COBE is the tool that brings them all into the light.
All right, theory is great, but let's make this real with an example. Let's cook up a hypothetical bank. Say its net bank credit is 1 lakh crore. It also holds 5,000 crore in those specific held-to-maturity bonds. And its total exposure to all that off-balance sheet stuff is 50,000 crore.
Okay, first up, let's calculate the ANBC. Remember the formula? It's just the net bank credit plus those special bonds. So that's 1.crore plus another 5,000 crore.
Which gives us a total ANBC of 105,000 crore rupees. Simple as that. Now, this number, it represents the bank's core lending and investment muscle. Tuck that number away for a second.
All right, now for the other piece of the puzzle, COB. We figure this out by applying our risk weight, which has the fancy name, credit conversion factor, to that off-balance sheet exposure. Now, in the real world, different items have different risks, but just to keep our example super clear, we'll use a simple factor of 100%.
So, that makes our COBA a nice round 50,000 crore rupees. This is the value of all those what-if risks we were talking about. The guarantees, the derivatives, the whole shebang.
And now, it's time for the main event, the showdown. In one corner, we have our ANBC, weighing in at a hefty 105,000 crore.
And in the other corner, we have COBE at 50,000 crore. So which one does the RBI actually use to set the target? The rule is just genius in its simplicity. You just take whichever one is higher. That's it. This makes sure that the lending target is based on the biggest, most complete picture of the bank's financial footprint. It's a really smart way to close a loophole, so banks can't just shuffle activities off their balance sheet to get a lower target.
So in our little drama, the ANBC at 1 crore 5,000 crore is the undisputed champion, is bigger. So that becomes our official base. That's the number we're going to work with.
Okay, let's tie this all back to our original question about that farmer. The priority sector lending target for commercial banks is 40%. So we take our winning number, that 105,000 crore, and we calculate 40% of it.
And boom, there it is, 42,000 crore rupees. This isn't just a number on a slide. This is the exact amount our make-believe bank is now legally required to lend to those priority sectors. We went from a big, vague question to a precise, data-driven, and enforceable answer. That's the power of these rules.
So let's just recap the whole thing real quick. ANBC is the main measure, the default. It's the bank's core business. COBE is the alternative, the backup plan that captures all that off-balance sheet risk. The regulator puts them head-to-head and picks the winner. It's two different tools, but they're both working toward one single goal, making sure credit gets to where our economy needs it to go.
You know, once you understand ANBC and COBE, you get this amazing peek behind the curtain of economic policy. It shows you how regulators use these acronyms that sound so boring and technical to achieve really important real-world goals. It kind of makes you wonder, doesn't it? Now that you know the how for this one little corner of the financial world, what other hidden rules are out there, quietly shaping our economy every single day?